Hi guys, welcome back to Marantz. Rantz, plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. This is a one-take session about Silicon Valley Bank. Now, this is Connecting the Dots Part 9. You guys know how I do this. We look at all the players involved. Is there a conclusion? There can be, but we'll see what happens moving forward. This is all happening in real time. This just happened 3 days ago, and I want to talk about it in detail. So I'm going to take myself off the screen. I'm going to give you the details that I do have, what I could dig up via some SEC filings, knowing who the board of directors are, and then just what's the agenda. We'll go from there. So welcome back, guys. This is Silicon Valley Bank, and this is everything counts in large amounts. Depeche Mode, shout out there to Wendy, not Wendy, Wendy, contributor to the channel, always around. This is by me, of course, Marantz Rantz. So we'll go down first. So the SVB is what they call it, and headquarters are in Santa Clara. And if you can really, I don't know if you can really see this too well, but I'll read it to you just in general. Just gives you a breakdown. It was a commercial bank headquartered in Santa Clara, California. SVB was one of the largest banks in the United States. From what I'm seeing, it's the 16th largest bank in America, but it's also the biggest for local deposits with 25.9% of the market share value in June 30th, 2016. And that's based off of what they call small to mid-cap companies. They're putting their money into this bank, and that's where a lot of startups have their money. Now, I've read that Roku has $450 million in that bank. There's a default on uninsured deposits of over 150, 170. Nobody can really get the number at this moment. Billion. I'm saying $170 billion that are uninsured. But we'll go into it and we'll see that the writing was kind of on the wall for everything, and we'll break that down. But that's as of March 10th, there was a run on the bank, which there should have been because of what was being alleged. So SVB, and that's who they are, financial group, which does business in Silicon Valley Bank, which is, it's national, guys. It's not just like, oh, it's just here in California. This is everywhere. They're from California to Boston, right? It's in a tough spot after a capital raise caused a steep 60% collapse of its share value, wiping out over $80 billion in value in the bank shares. Now, if you guys saw the action on the ticker is SVB, I will show you what it looks like right now and what happened to it. But this happened to SVB on Wednesday. It launched a 1.75 billion share sale to shore up its balance sheet. They had to sell shares because they were unable to raise capital. The deposits dried up, and we'll go into that and how that all works out. I took out this middle portion of this chart here. I'm going to go ahead and see if I can show it to you guys this way. So right in here, as you guys can see my mouse, I'm pretty sure. You're going to see that most of their loans and the way they did it, the loans equal or greater to $20 million to any single client, individually aggregate, totaled $46.8 billion, which is 63% of their portfolio. You know, as a bank, when you get deposits, they can put them into treasuries or they can re-loan it out. They can figure out however they want to do it. But if you're going to loan out your deposits, it's like working with people's capital, right? It's almost like FTX in reverse, where like FTX was taking individuals' deposits and then, they were investing them in a failed company. In this case, they're taking deposits and they're loaning them back out, but they're over leveraged at that point. 63% of their portfolio is loans. You would ideally want it to be treasuries, because remember, banks only make money off of what? They'll track it two different ways. Like they can say we have assets or we have, this much assets under management. But the truth is, how much money do you make minus interest, right? Because the Fed is increasing interest rates. It's putting pressure on those companies to keep depositing money. They're taking on payments of that kind. I'm going to spell it all out for you. I'm going to show it to you. But I will go into that in detail. So at the close of business on March 9th, the bank had a negative cash balance of $958 million. Of course, the FDIC comes in. They're going to save anyone who's $250,000 or less. But chances are most people that are over that, they're in big trouble right now. And I feel, and I'll give you my conclusion at the end, so I won't even go into that. Let's look at this. So as of March 31st, 2022, they had total deposits of $198.1 billion. That was their total deposits as of March. Now, when you go to December, and this is all last year, within 6 months, they already had Total deposits down $25 billion. That's a huge drop off on total deposits. In addition to that, they had total loans and their cost for doing business, basically $74 million was an increase from the 68.7, right? And total investment securities of $120 billion decreased $7 billion when before 6 months prior was 127. So what this tells me, and assets of, there was we had a total assets of 211 billion, previous 220. They lost another 9 billion there. What this tells me is that people are already pulling money out and or not putting money in. They couldn't carry over the amount, but that was in a 6 month span. They lost $25 billion. And excuse the noise in the background because no edits, no cuts, by the way. Let me go and put my phone on mute while we're here. Apologize, guys. It's Saturday morning, and I've been doing a lot. So back to you guys. As you can see, they lost 25 billion. That's 12%. I know that's not a lot to you guys, but in the banking world, that's infinite. That can crumble you. Now, net gains on warrant exercises, this is in 2021, were from the IPO of Coinbase. So they actually put out Coinbase a direct listing. That they're the ones who did it. And they made over $446 million. In 2022, they had a net loss of investment securities of $285 million. This is net loss compared to the net gains of 761 in 2021. So they actually had, that's $1 billion flex, right? So as you look at it here for the year that ended December 2022, net income was 1.7 billion compared to 2.7 billion in the previous period, the previous year. The thing that I associate that massive drop off, $1 billion worth, I think I know what it is. And obviously we don't know for certain until somebody goes and breaks up this bankruptcy, which from what I'm reading, Sullivan and Cromwell are managing the bankruptcy. Go figure. They're also managing the bankruptcy for FTX, and they went ahead and already charging astronomical fees for that. But we'll go into this. Wealth management and trust fees are new core fee income line, and they ended in 2021 respectively $80 million, $83 million in 2022 compared to the $44 million in 2021. The increase was due to the acquisition of the Boston Private. Now they bought Boston Private. They bought a bank, and we're going to go into that transaction. Client investment fees were $386 million on 2022 compared to $75 million in 2021. The increase was reflective of improved fee margins resulting in high short-term interest rates driven by the 2022 federal fund rate increases. What does that mean? That means that the Fed increases rates. The individuals, the clients, have to pay more money. They're now paying more money to do the same business they were doing before. And guess what? It's when you become illiquid. You don't have any liquidity in your bank. You're dry. So you have no money coming in at that point. People can't pay these interest rates. Now, you don't see it in the housing sector. You see it in the automobile sector. They're drying up because interest rates are instant there. But, housing loans take 45 days to close, and then you have to reestablish a new price point if the deal fell through. It takes time in real estate. Over here in automobile world or in banking world, that's what these guys, they work off. They work off of the loans themselves. It's almost like oil. The price of oil can fluctuate, but before you see the difference at the service station, it takes 30, 40 days. So there's no difference here. When the Fed is doing what they're doing, they are inducing a recession because they have to control inflation. And remember, I told you that equilibrium breaks, it snaps. And that's what it looks like it happened to this bank. They're over leveraged, but those are riding on the wall. Here's what I feel is happening. As I read their SEC filings, right, the prospectus, and they were trying to say what the risk was, I wanted to focus on SPACs. I know I talked about this in maybe part 2 or 3 of connecting the dots. But if you guys don't read this passage, this is from their filing, their most recent one, their prospectus. It said, much of the recent deposit growth was driven by our clients across all segments, obtaining liquidity through liquidity events such as IPOs, secondary offerings, SPAC fundraising, and venture capital investments. Now, we know that they had an unprecedented amount of SPACs come onto the market in this past, look at this. I'm going to show you the chart here. This is 12 years worth, and you're going to see what exactly? That over 1,030 SPACs came out in 2021. So your bank's going to look amazing. Remember, it's free. And I say free because you're parking money and you're borrowing money at 0 interest rates. There was really low interest rates. And now when you have 1,000, 14, you have a combined 1,500 companies open up via SPAC in 2020 to 2021, this bank is giving out money. And we know that they're the second largest private, I don't want to say private equity, but they're the second largest bank that gives to these startup companies. And when you see that being tied up compared to what it was beforehand, this is what's crumbling this company, in my mind, is that these companies are failed. Have you seen all the SPACs that have like evaporated out of nowhere? They were there, and now they're not. Just to give you an example, 1,500 in 2-year span in the last 2 years, 2023, 2022 so far, under 100 total. But let's go ahead and look at the money, because this is where I get mad. Okay, compensation and benefits expense was $2.3 billion in 2022. Compared to $2 billion in 2021. The key factors into driving the increase is compensation benefits expense. So they actually paid $300 million more dollars to their executives in 2022. But the way they did it is dirty, guys. It's a dirty way of making money, and I'll explain it to you. They did not, they took away the bonuses and gave them base pay increases. That means they were underperforming in 2022. And they said, we still want our money. And that's how we did it. So a decrease of $116 million in incentive compensation plan expense related primarily to the decrease in our incentive compensation plan accrual as a result of our 2022 results. Do you get what I'm saying? But they had an increase of $359 million in salaries and wages expense. And they did that because they didn't perform well. So what do? When you don't perform well to your bonus standard, we just go give you a base pay increase. It is the bank paying themselves. Now, who allows this, and what would be the writing on the wall? Well, let's go ahead and look at this right here. If you guys don't know, SVB went ahead and took out $800 million worth of senior notes, bonds. And who allows a company to do this? Because they already had outstanding debt of $2.6 billion. That's it. Unsecured senior debt of $2.6 billion, right? They took on another $800 million. I know in the world of meme stocks, you guys are like, what's $2.6 billion? That's nothing. That's a lot. And I'll explain. People don't respect that number, but it's a lot of money when someone's going to your bank asking for their money and you don't have it and you owe. Now it was going to be, I believe, $3.4 billion upside down. Who allows this to happen to a bank? People say it's okay. Companies operate with debt all the time. Companies do. Banks try not to. That's the difference. Now, who was the underwriters and who gave out this whole deal? Goldman Sachs, Bank of America, and Morgan Stanley. It's weird that they do Bank of America. And the reason that I have that is because we're going to see ties to Bank of America real quick. But here's the problem. The merger of the Boston Private Bank and Trust Company with Silicon Valley. This is in 2021. The issue that you had here was they bought a bank for $900 million. Remember, they only have X amount of dollars in cash each year. They don't make much. But to be in debt already 2.6, and now you buy this, it really tells you what's happening. They're overextending themselves. And it's not a good deal. So we're excited to welcome our new colleagues and clients to SVB and are appreciative of everyone in the Boston Private and SVB who worked diligently to help us reach this milestone. And that was Greg Becker. Greg Becker, welcome to the spotlight. Welcome to the channel. You're going to get your roll call in a minute. Now, Silicon Valley is the California, blah, blah, blah. We can read all this. This is in 2021, guys. They only had total deposits, $125 billion. So you saw in 1 year, they went all in. And this is March of 2021 to March of 2022. They went from 125 to 190. Guys, they had about $70 billion put into that bank. That is a pump. That is a pump and a dump. And I'm going to show you what that looks like on the real chart in a minute. But to have a stock, guys, their stock price went from from nothing to $750 a share. Now it's back down to $30 a share. You guys don't understand what I'm telling you, but I'm going to show it to you. Boston Private is Massachusetts, blah, blah, blah. They only had $9 billion in total deposits, the Boston Private Group. So they paid $900 million just to basically get a control of $9.2 billion. Doesn't mean they make $9.2 billion. No, they actually paid $900 million cash dollars to be in control of the 9.2. It's crazy to me in a way to say that Boston Private was willing to sell off for 900 million when they have a business plan and they're worth more than that. It's just me. But how does that 9.2 and 125 equal 190? It doesn't. It doesn't, because it's a pump on the bank. And I told you, it might be via SPACs or it might not be, but it's going to get worse. So here you go. Boston Private is now part of SVB, which everyone was excited about. They had 4 people part of this deal. Anthony DeChellis was the CEO in SVB. He was actually from Boston. And when they bought them out, they made him the CEO of SVB. It's just crazy to me. Yvette Butler, she was with SVB. Jim Brown, and John Langley. So that's what they tell me, who was part of this deal, who got new roles and everything. Guess what? None of those employees, none of them, well, 3 of them, they don't work for SVB anymore. They all left. John Langley, who does work for SVB, used to work for BlackRock. And he was with Citi for 17 years, but he also used to work for BlackRock as well. And he's still there. He's the only one still there. Here's the main guy who got everything, and they part ways with him now. This is DeChellis, whatever his name is. This guy comes from a company, and I had never even heard of it, guys. First time I ever heard of it. It's right here. It's called, goodness, not the Boston Clearing, none of this. You know that he was a founder. He's with Boston. I was just showing you his thing here, but it's called Our Crowd. I never even heard of Our Crowd, but apparently it's a company, a bank, the number 1 bank right now in the world in Jerusalem. It's crazy. All the Saudi money, all the Israeli money, it's all there. It's called Our Crowd, and they've got a big portfolio, and it's growing. But this guy was the CEO of the Private Banking of Americas for Credit Suisse, UBS, Merrill Lynch. This is just a bank guy. Now, what happened? What happened to this guy? Well, before we even talk about what happened to him, remember this, SVB also bought out Lyric Partners. When they bought them out for $280 million cash up front in 2018, they didn't have that much money either. But it looks like they just kept trying to, because that's a Boston area bank. But what it means is, like, they were really trying to get into Boston. I'm like, man, these guys are dying to get into Boston. They're going to pay whatever it takes. They paid over $1.2 billion for this bank, for these 2 banks combined. And why are they trying to get over leveraged? I don't get it. And then people pushed them over the edge, right? But here's the crazy part. These are the guys who made it happen. I'm sorry. These are the guys that allowed it to happen. And I'm going to show you each and every single one that I could find some juice on that I thought was weird, but it kind of has like a narrative. And I'm going to come to a crazy conclusion. You might call it a conspiracy theory, but we'll go from there. SVB Financial. Now, this is a bullshit headline in a way, but I get it. It should be up there. He sold off the shares. This is Greg Becker. He's the CEO and president of SVB Bank, and he sold off the shares. And he made $3.6 million in the stock nearly 2 weeks ago. And the issue with that is they're going under now. You knew that they were over leveraged if you're on the board of directors, and certainly if you're the CEO and all this going on. But you knew you had to raise capital. But what'd you do? You don't care. You go and sell the shares and you make your money while it's high, because it was at $350. To give an example, this is the stock in the last, this is the 4-hour chart. And this stock is still cheap, Kramer said. And this at the time, the stock was $320. Jim Cramer urges viewers to buy Silicon Valley Bank stock last month. Yeah, I actually know somebody part of the Jim Cramer investment group. They get the newsletter. I read it all. I made copies of it. I wanted to read it like last week, 2 weeks ago, when they were talking about Costco earnings. And I was like, these guys are clueless. Like, I don't know who actually pays for this, but it was an older lady who's involved with that. And now when I look at this, I'm saying to you, guys, the $347.99 is not even half of what the stock was in 2021. That's right. When the SPACs were pumping money into the bank, they were going crazy, and everybody was owning this damn thing. And I still remember people looking at it and saying, this is a run, it's great. But when you have a run on a bank, this is how fast it happens. It happens in a day. You lose all your value, 90% of your value. Right now, the stock is halted. They wanted to control it. They wanted to take care of it, and because it's gone. But here's who's in charge. Here's the problem. Right here. And Greg Becker, President and CEO of SVB, speaks at the 2022 Milken Institute Global Conference. Yes, He's invited to the distressed credit haven, Milken Institute. You guys already know that if your board of director, if anyone in your company is over there at that institution or at the Wharton business, the business school, if they're at that convention, they have one too that's called the Distressed Credit Committee Convention, whatever. And if you go to one of those two, you know that they're setting you up for bankruptcy, they're setting you up to be over leveraged, and they don't care about anything but themselves or whatever bonuses and value they can get from it. This CEO is no longer a director at the San Francisco Fed. So he was also on the board of directors at the Fed. It's crazy that banks are allowing banks to be involved with banks. And what do I mean by that? Well, I'll show it to you in a minute because we're going to see how many people are with other banks currently and still on this board of directors here, which is, I'm just like, is that not a conflict of interest? I guess not. SVB's deep understanding. Now, look at this is him, Greg Becker. He went to the Senate and he goes out there and he appeals to them and says this: SVB's deep understanding of the markets it serves are strong risk management practices. Becker argued that his bank would soon reach $50 billion in assets. This is in 2015 when he argued. He said, which under law would trigger enhanced prudential standards, including more stringent regulations, stress tests, and capital requirements for his and other similar sized banks. His testimony, in his testimony, Becker insisted that $250 billion was a more appropriate threshold. So he doesn't want oversight on a bank that has under $250 billion, assets under management type style, when they have that much capital. The reason why he doesn't want that is because they don't want them to look into their books, how dangerous they are. If you told your investors that the risk that you're putting your bank under daily, hourly, weekly, yearly, you would have a run in the bank and no one would do business with you. But they had a floodgate for all of these IPOs and SPACs that I've never seen. And I told you that, but I just didn't know what bank was doing it because you guys, you know what? I'm paying attention to GameStop. I'm paying attention to AMC and Bed Bath & Beyond. But somewhere down this road of connecting the dots, you find this. Kay Matthews. Kay Matthews is the chairman of the board for the board of directors for SVB. Now, she's the main one. They just put her in charge in 2022 in April. She's the fall guy, right? No, I don't care what they do. I know exactly who this person is. You read it. She's worked for 36 years at Ernst & Young. At Ernst & Young, if you are evaluating, you're an accounting firm, and you're dirty, and you have so many fines from the SEC, which they do. They're one of the worst accounting firms, and they neglect a lot. Yes, AMC has hired Ernst & Young. Numerous other companies have too, but she's one of the founders. She's one of the main people there. She's the real deal, and that's what she is. So if this bank is running under the guise of Kay Matthews, how much worse can it get? I forget why I put this one here. Maybe I didn't clear it. Jeff Mag, I don't even know how to say his damn name, and I don't care. Corsona. So if you lead here, I just wanted to show you that Boston Clearing Corporation. So Boston Clearing Consulting Group, they actually, and I say Clearing Corporation every time I do that. Boston Consulting Group, that's what he's in business with. He's done business with them, and Corsona CEO. He's on the board of directors. Garen Staglin, I have more about him in a minute. Not on this page. I know I put him here, but I didn't mean to, so I apologize, guys. I'm getting it done this morning. Kate Mitchell. I do have a problem with Kate Mitchell. Kate Mitchell actually runs Bank of America, the venture arm. So she was with Bank of America before she ever got here. Years. And she's been with Scale Venture Partners, which is Bank of America. If you guys don't know, they broke off from Bank of America. They formed their own arm, and she's been involved with both. So they changed the name. So if you look up here, 2007, the firm spun out from Bank of America and changed its name to Scale Venture Partners. But it was all Bank of America. So even though it says Scale Venture Partners, December 1996, for the last 26 years, that's actually Bank of America. So how is it that you can be Bank of America, be in their partners, run their whole sector, their whole arm, but yet still be involved with this bank and make financial decisions for this bank? Other than you can tip them over at any time, you can crumble them. But it's funny that They spun out in 2007. You guys go do the math there. But Kate Mitchell, she gets no pass from me. This is all hiding exactly what it is. So then we'll go to the next one. This guy's kind of weird. Garen Stragland. Nobody really talks about him, but I want to connect it to you guys. Not only is he the director at SVB for the last 12 years, he's also currently, this is the crazy part for me, with FTV Capital. Okay, guys, he's senior advisor with them for 18 years. FTV Capital gives money to a company like to a guy like Christopher Hendrick. And I'm showing you because I wanted to show you this. Oh, by the way, he's a member of the National Finance Committee for Barack Obama. Yes, that does matter because this is where I'm going with this whole thing. Hendrick raised money for via FTV Capital. Who is Hendrick? He has been he's been recognized by Johnson & Johnson plenty of times, and Johnson & Johnson, the Bill Gates Foundation, the Gates Foundation themselves. This guy actually used to work for them. So prior to joining Locke administration, he was the founding director of strategy and operations for the Gates Foundation. Next is he worked for, and we go down here, Microsoft. So as he worked for Bill Clinton, the donation was announced in a joint event between Bill Clinton, Microsoft, Bill Gates, which Hendrick proposed and managed. So he has direct ties to Bill Clinton, direct ties to Bill Gates. Christopher Hendrick has to get his money from somewhere, from a bank. And who's the bank and who are the advisors? Right here, Garen Stragland. I want you to know that. Another person on the board of directors, and I can't make this up, is Mary Miller. Mary Miller is an American government official and political candidate who served as Undersecretary in Domestic Finance and former acting Deputy Secretary of the Treasury in 2020. She announced her candidacy for mayor of whatever, Baltimore. She didn't win. Who did she work for? Barack Obama. She was under the administration of Barack Obama. When she resigned in 2014 from her post, it was not filled. That position was not filled again until our current president, Joe Biden, filled it with another guy. This individual, Tom King's on the board of directors. Tom King, I know you guys want to see it. He went to the Wharton School of Pennsylvania. Yes, the Wharton way. He worked for Barclays. He worked for Salomon Brothers, which was acquired by Citigroup. How are bankers working for bankers? How are they making decisions for your money when they actually run a different money? Allison Davis is on the board. She worked for BlackRock. Yes, and additionally, she also worked for McKinsey & Company for 9 years. And you know McKinsey & Company is a consulting firm, one of the five most, I can't even get them, don't even give me BCG, McKinsey Consulting, FTI, they're all the same. Now Elizabeth Burr, yes, Elizabeth Burr, they just put her on. They call her Buzzy or Busy, or I don't know what the hell they call her. Burr most recently served as a CEO and VP of Humana. She also was involved with Morgan Stanley, Credit Suisse, VP of Global Branding for Gap, which I really don't care about that part. But she also ran a company called Carrot, and they encourage everyone to stop smoking. I know it sounds like a great initiative, and it is, but this is all during the pandemic. They're pushing money to these companies via the pandemic, and it's that other guy's company, the other guy who's tied up, and then this one. So when I went through it all, I was like, man, they really have ties to healthcare? And they do, because I want to say it's, let's go up to, was it Galen? One of these guys on the board, I don't know which one it was. It's not here. Oh, man. I got to find out who it was. But they actually push out, I believe it might have been Galen. They actually have a company that pushes low-level workers to go work for hospitals, healthcare. And when they do that, that's all COVID money. I'm sorry to tell you this. So let's go to this. Just to give you an example of who Buzzy Bear is and how she feels. She has a lousy view out of her window. She's looking at Trump Tower. She's going to tell you police are not warriors because they are not and must not be at war with our neighbors. Defund the police. Next thing she's going to tell you, because this is quoting a four-star general, the president has failed to show sympathy, empathy, compassion, and understanding in some of our traits and the nation will needs from the highest office, whatever, in the national needs. Okay, who cares? Listen, they all lean left, all right? That whole bank leans left. And if you need something to crumble for this administration, well, hell, now I'm going to reach, right? Now I'm going to reach, because what is it? How many dominoes need to follow for you to put the blame elsewhere, right? Would it be corporate greed? Would it be SPACs and IPOs manipulating markets and prices? I don't know. What I do know is when they say there's no contagion, right? Like this is just going to fall on itself and it's not going to have any effect on any other bank moving forward, is what I've been reading and what I've been told. I'm telling you, that's not my experience on this. I saw what happened to Lehman Brothers. Lehman Brothers crumbled. 11 days later, Washington Mutual crumbled. And that's the largest bank failure of all time, right? Bear Stearns crumbled before that. So you're looking at 3 dominoes falling and it putting us into a recession and this whole world reset. Well, guess what? The rumor is nothing happened, as in the Fed bailed out everybody. Right now, today, Janet Yellen, Jerome Powell, they're sitting there and they're talking and they're wondering, what the hell do we do next? Do we bail out this bank? Do we bail out all these companies that can't pay their employees now? Because they went to the bank and you can't pull money out. It's ceased. I got a new little notice from Wells Fargo. Told me, don't worry if there's any inaccuracies on your bank. I've never seen that before. Who's nervous? What's the collateral damage? They're not going to tell you, guys. They're not going to tell you. They're going to try to mask it or they're going to bail it out. And I'll wait. I'll wait for the administration to say something. But from what I see, this company here, this bank here, already had so many ties to the administration, or the feeling of it, right? They have this persona that, you know what? It's okay if we fail because we're going to get some backing or we're going to get help. And if they don't, then you know that the big banks that gave them those senior notes just this year were ready to take on their portion of the cake. You know what happened in 2008. You know who got called up and got called to the meeting at midnight, and it wasn't Lehman Brothers. It was just Bank of America, right? Merrill Lynch. It was JP Morgan, Chase. You guys know what they are. They're the big banks, the big boys. And they're not going to let you play. They give themselves raises. they change the book. But I want you to see what SVB is. Oh my God, I said SBF. No. But SVB, as you look at this, you're going to lose plenty of money moving forward. If you start trying to buy the banks now, because they're telling you these are bank opportunities or big opportunities to buy the other banks, I would tell everyone, me personally, I'm staying away. I don't need to go put money in to get it on big banks because they're going to go pick up these assets for nothing, for cheap, via bankruptcy. No. I want no part of it because I don't know how big this is going to be. What I do know, I own a couple of shares in a lot of good companies that are still doing great that didn't have money over there. So that's what I do know. Connecting the dots, guys, figure it out. You see a lot of the same names, a lot of the same companies, but I just call it corporate greed. That's it. You can't explain it to me any other way. And when people leave and come and go and they sell their shares, like the former CEO did here at SVB, he left. He sold shares. He left because that chart looked so great. It's called greed. All right, guys. Good luck. Enjoy. Connecting the Dots 9. Hope you liked it. Peace.